Thanks. Thanks all for coming. Before we begin, just a few points of housekeeping. There's packs under your chairs. These have got some goodies in, so these are obviously to avoid distractions. They're under the chairs. There's a notepad and pen on your chair, so you can make notes as you go along. You're twice as likely to take action if you take notes, so it's important. It's being recorded, so we can share the content afterwards. If you've missed anything or you've got anything like that. Why are we here? Who am I? So A4G are a chartered accountancy practice based in West Kingstown, just up the road. We sort of pride ourselves on being more than just the compliance accountants. Whilst it provides the fundamentals of the services we provide, because it's important to all businesses, for us it's actually about being able to provide services that go above and beyond just the compliance services, just the tick boxing. Our mission statement to be the best all-round advisors means that for us it's about the advice, not the numbers. Although the numbers can play a huge part, it's more than that. For myself, I've been A4G for 13 years, since I was 18 years old. Tells you how young I am, and it's been a huge part. I've taken the journey from a junior who didn't know anything up to being one of the principal advisors who's solely responsible for the advice given to our clients. Construction has been, my entire life basically. My granddad, my dad, my uncle, brother, they're all in construction. So for me, it makes complete sense. I have to hear it at weekends, so why not hear it during the week as well? Who else is here today? So we've got Peter Sell from the Profitable Contractor. He'll be speaking shortly. We've also got Connor, who is currently en route and hopefully be here shortly. Want to say a big thank you to our sponsors. If you could, at the moment we've got one of two. So we've got Steve here from Bibby's, who deal with construction finance, and Paul Fabita, who again is on his way. What you're here today. So today what we want you to take away is how you can how you value your business, how you understand your business in a bit more detail, how you can improve those metrics, and therefore how you can take away a plan of action so you can get to where you want your business to be. I have a problem. This is not a statement, it's more of a question that I was asked from a client. Given the weather outside, I imagine most people have problems right now. But at the moment, so I had a client come to me who said that they were looking at their annual results, they'd been working hard, turnover had grown, but actually they weren't seeing any impact in their margins. They'd cut all of their overheads as much as they could, but it still wasn't seeing the profit at the end. We looked at, so the next port of call is what was causing their margins. So the first is if you're spending too much on materials. Not particularly an issue, most people are really good at buying, but actually you might have wastage, you might have items going missing, you might have other issues. If you're not calculating all of your costs when you're quoting, so if you're looking at, you're not including adages, screws, nails, the sundry that comes with it, then actually that can have impacts on your margins here and there. If your staff aren't working efficiently, perhaps they're turning up late, they're lazy, or you've got issues where they can't get onto site at times, that will impact on your margins because you're outlaying cost but not seeing any of the income. Again, if you're not monitoring and managing your projects, it means that effectively any delays or trades clashing just means that you're not able to see that profit properly, and it means that your margins will be impacted. If you've got variations where you're asked to add an extra socket or add an extra beam, or things move, scope creeps, these will impact on your margins if they're not invoiced for up front. We had the discussion, we looked at his margins. He was slightly reluctant on making a lot of changes. He was looking at actually, should he give up? How does he get out? So we discussed what his business was worth. Now, what is a business worth? It's only worth what someone's willing to pay. But we can get to a reasonable value based on a few calculations. So the calculations we look at is an EBIT. Typically it's an EBITDA, but for construction it's important to understand if you've got assets, the depreciation can be of value and necessary to your construction. What this means is we take the EBIT of of a reasonable year's profit. And what this means is we make adjustments, we give you a real true value to a third party, and we times it by a multiplier. So if we look at how this looks in numbers, we can see this is a company that's growing from 3.9 to 4.1 million, which is great, business is growing. But actually, if you look down the figures, you can see their profit margins are getting worse. They're spending more on materials than what the growth is, and in terms of labour. So it's important to know margins to slip in, but what does that mean for the numbers? So we take their standard results, we look at making adjustments. So these are the common examples where we're looking at perhaps your business is structured for tax efficiency, or you're looking to draw more out of the business, but it's about making the adjustments of what your business would mean to a third party. So we make market rate salary adjustments. If you're paying rent to yourself, perhaps under value, then we would look to include that. For this example, we'll just include an £80,000 salary for the director. And what that means is that our £200,000 EBIT for the current year has now become £120,000. So it's reduced that down based on us making that salary adjustment for the director. We then look at the multiplier, which for construction at the moment is seen as between 2 to 4. This can range, varied on the industry you're in, the risk you've got, whether you've got recurring jobs, which are seen as more attractive, or if you've got one-off jobs where the director is reliant upon, actually there's no real value. You'll get some money for selling your black book, as it were, but actually there's minimal value. So that multiplier will change and flex depending on your industry and the return you're able to give. So if we multiply those figures, you're looking at a valuation between £500,000 and £250,000 and £500,000. Does anyone think that's enough to retire on? No? Me neither. In terms of then we then look at how you realise the value of your business. So there are a number of ways in which you can sort of enhance the value of your business, improve your results. The first I mentioned earlier, which is cutting your overheads. I mean, if anyone's tried to save the £8 bank fees, you realise how hard it is to just open a new bank account. So there's no point spending your time saving £8 a month on a bank fee. The most efficient place is your profit margin, so your gross profit margin. So in the previous example was 14.6. The industry average for construction, again dependent on what you're doing and what area you're in, is 20%. So if we can shift your gross profit margin from 14.6 to 20%, it means we're in a position where we can have better figures on our EBITDA. So that increase from 14.6 to 20% means you have £220,000 more gross profit, and in turn that's directly reflected on your operating margins. I mean, a 1.4 valuation or 700,000 is a lot better than what we saw previously, but not quite there yet. How do we get from one to the other? How do we realise that value? It's a 280% increase for a 37% increase on your gross profit margin. I mean, who's going to turn down a 280% increase in your value? So to get there, we have to set our strategic plan. This is made up of 5 steps. The first step is, where do you want to be at a given time in the future? What do you want from your business? Do you want to be running a £1 million business? Do you want to be running a £10 million business? Do you want to be working 4 days a week? Do you want to be spending one of your days networking or perhaps playing golf? James. That's where you sit. So what do you want from your business? What's important to you? We then look at, where are you now? So this is your management information. Where are you? What do you need? What's your current gross profit margin? How hard are you currently working? How many roles in your organisation are you currently undertaking? Understand where you are. We can then set our goals for a strategy on how you get there. This is split into 2 sections. The first is the numbers and KPIs. What does your gross profit margin need to be? What does your turnover need to be? What is your break-even point? What do you need to break even to reach your goals? The second is the resources that you need. Do you need to buy a larger plant, more plant? Do you need more time? Do you need more staff? What do you need to get there? So in order to achieve those and set those, we've got a 5-point action plan. The first is to get your technology right. So traditionally, everyone looks at their software. If you're looking at new software, it's normally operational and front end. But actually the accounting software provides the foundations. For those of you, I mean, when I started A4G, these were just going out, but we had ledger books back then. And then it turned into Excel. People had their income and expenditure in an Excel spreadsheet, and we've now moved on to accounting software because the need for data to make decisions is greater than it ever was before. So our recommended software is Xero. I'm assuming everyone's heard of it. How many people use Xero? There you go. So yeah, so it's important. So Xero itself, if you've not seen it, you've not heard of it, it's very intuitive. It's built by business owners for business owners. So it's important to, it allows you to use the software how you want to use it rather than anything else. The reason we love it is because it provides an ecosystem that's more than just accountancy. So there's 1,000 different applications which are in the background and can tie into your software and make it better, provide front end, back end, and go from there. The first port of call to automating your processes, automating means that you can effectively save time, duplicate double entry, and minimise the risk of any errors that you find in your system. So get Xero right first. Make sure you've got bank feeds set up, the first port of call. Pausing your bank feeds, information's there, ready to be reconciled. The second is bank rules. For anything you've not got an invoice for, have bank rules set up to ensure that your bank charges are being dealt with right, or anything like that. From there, we can then consider how we use the information within Xero to then go further than that and build our ecosystem. So the first way is that we take the information in Xero and take it out of Xero. So the first app we've got is Chaser, which effectively takes your debtors within your system and it automatically chases them. So it's an automatic payment chasing system. It means that you don't have to necessarily have a credit controller, you can save that cost. And you only then have to escalate or chase the longer debts, the larger debts. Chaser will do the bulk of the work for you. The second app is Approval Max. This is a multi-step approval process system. So if you've got purchase invoices that are currently being printed and passed from one to another, Approval Max will allow you to have a strategic digitized system which effectively emails the first person, approve your invoice, and it will go through the stages. It also has a powerful PO to invoice matching system, which can do the same, which matches it at the same time as pushing it through your approval process. Once you know how to use the information within the system, it's then making sure we've got something that can push your information into the system. So Dext is a automated invoice processing. You take photos on your phone or upload a PDF, and it will automatically push them through the system into the system you've got. The other thing, obviously in construction, is our job management system. So in terms of a job management system, again, there are a number of options you've got. The first is where most businesses started, which was with a spreadsheet, managing jobs, income, expenditure. A lot of businesses are still there. Even large businesses are still trying to manage their income, their expenditure by job, by category on an Excel spreadsheet. If that's got too much, you can consider Xero tracking categories or Sage project costing if you've not seen it. Effectively what this does is it takes the information, you categorise it appropriately, and you can get an income and expenditure within your accounting system. Xero Projects takes that one step further, where you can include budgets and estimates for what you want to bill or what costs you're going to incur, and you can easily have that differentiation between what you estimated and what it actually cost. To take it a step further from there, we've then got our introductory or starter job management softwares. These sort of have a more rigid structure to how you approach. It's a step-by-step, complete step A, B, C, D, in that order, otherwise the system will sort of not really like it. For us, we've got two different introductory job management systems. So the first is ServiceMate. ServiceMate is great at setting staff schedules, tracking the whereabouts of staff, but it falls weak on when you're trying to manage materials. It doesn't really deal with materials at all. So you'd have to change the system or have a separate system that would deal with your materials, which can be a downfall. On the flip side, live costs, is really great at managing your materials. It's got integrated live catalogues. It enables you to raise purchase orders seamlessly, etc., etc. But it's very weak at managing your staff and managing the scheduling. If that's not, if you need more than that, if you're not going for something for a specific need, then you need something that's a bit more comprehensive and can cover a wide category of where you are. So that's where something like SIMPRO will come in. So they've got better staff tracking, better flexible management process, so you don't have to follow the process set out by the software. You can jump in, jump out, have different software, different strategies. And it also allows you to have more control over your materials. So if you've got materials that are in vans or on site, or you need to allocate, the software will allow you to do that. It gives you a bit more of a comprehensive approach to managing your jobs. So if comprehensive isn't enough, you've got the option of custom. So you can go out, you can build your own software. It's expensive, you're required to maintain it. The responsibilities are you to innovate if you need something different, but you do have full control. So that's the benefit. I mean, we're talking hundreds of thousands for custom rather than hundreds of pounds. So that's the difference in costing. And I'm going to hand over to Peter, who's going to run us through tendering and quoting to get your margins right.
All right. Well, thanks, Joe. For those that don't know me, and I know quite a few of you already in the room, my name is Peter Searle. I came out of corporate life about 8 years ago now, and was working for a main contractor. And what I wanted to do was help smaller businesses in the construction cycle, help smaller businesses with getting better at what they do and making a profit. And one of the things that was key to them was actually making a profit. So I set up profitablecontractor.co.uk. It's got a website, hell of a lot of information on there. Some of it I'm just going to run through briefly for you now, and a lot of it reiterates what Joe's been talking about. So if we just look at the accounts, shut up. Right. How do we turn the sound off? Didn't realise that was still on there. Yeah, right. Thought that was off. So we start off with the top of the accounts. So it's the income, and this is the summary of all the projects. So whereas the accountants talk about your income or your turnover, how it's running by itself, isn't it? Oh, sorry about this. Yeah, it's going to do this. Sorry. So the all the projects go together, and then you take out what the actual project costs are individually to get your gross profit for each project. Then you take off all your fixed costs, the overheads, and these come all together, which leave you with your operating profit, or EBIT, as what Joe was talking about. Now, when you come to do estimating, then everybody is effectively equally qualified to do a job if you're pricing jobs that are exactly the same as everybody else. And this is about selecting the type of work that you go for, so that you're not in a pool of work where you're in the race to the bottom. The ideal is to always try and price work where you're equally qualified. If you take, for instance, these sorts of examples, you know, the painter or the electrician on each of these types of jobs, whether it's a heritage job or a warehouse or a care home, will have different skills. Somebody that was working in a prison might have to have passes and what have you. So you actually set yourself up so that you only do the jobs where you're qualified like equal contractors are. And that way, when you start to tender it and price it, the actual direct costs are probably going to be the same, because you're going to take the same amount of time to do it, you're going to be going to the same suppliers, you're going to have the same sort of qualifications. So you're all equal. That's the green. 4 contractors are probably going to be equal on the actual cost of doing the job. What then happens is you add to that your overheads. And the overheads for every business will be different. Some of you have got expensive cars, some of you have got small offices, some of you got a lot of work on, and some of you got less work on. So the percentage that you add on for your overheads to get to break even will vary. Then the little black line there is the profit that you add to the top of it, and that can vary. But what it does is it sets the absolute ceiling that a business wants. And what you can do is then you can see the break even to what the maximum profit is for every different business is going to be different. So the business on the right there can actually make one hell of a lot more profit. Now they might be a business that's got a business strategy that they're ripping out, they're not actually spending very much on investing in their overheads, and they're ripping the money out. If we look at the figures as an example there, as £100,000, cost of sales for each project 70, the overheads are going down between 20 and 5, and the net profit that's available to each business is different. The one on the right, because they've got the potential for a lot of profit, can then charge just say 5k less and win the job. So what they do is they say, I've got this direct cost, which we're all equal on, I've got my overhead, which I know out of my accounts, and I'm going to end up adding X amount of percent for profit. But I know that's probably going to not win the job, so I'll just take a little bit off. So you start at ceiling, take a little bit off. A lot of people try and work up the other way, but unless you measure yourself from KPI against the market, you never find the market. And this is a good trick for always trying to win jobs at the highest price. Now, imagine that that's the price in the market. Company C thinks, I need a bit more work. So what do? They decide to take slash their price, the race to the bottom, and they might take off say 15 or 20,000 to win the job, break even, but win the job at a lesser margin. But what they've done is they've actually left this amount on the table. They could have priced it a bit higher and still won it. You only need to be £1 less than second to win it. And if you win it at the highest price, then that's when you start to really start making money. This person here has just thrown away all that profit because they haven't pitched the price at the highest price. So takeaways from tendering is work out your true overhead, which is what Joe was talking about, benchmark the market, and then win projects at the highest price the market will bear. And then finally, understand the difference between markup and margin. I've been talking about margin, which is the percentage that comes out of the accounts, but when you're adding the percentages on, the calculation is different. So let's say, hopefully you've won a job, yeah? How do we go about making money out of the jobs that we've won? So this is about managing your projects, and Joe's already touched on quite a bit of this already. There's a mining engineer called Henry Fail that came up with this management process. So you start with planning, how you're going to do the job, you organise the resources for it, then you decide what those people are going to do, so you give them the instructions, you delegate out the work, you coordinate it, give them the timings of when they're supposed to work, and then you review how it's going on. Now, central to all of that is communication and esprit de corps. This is just running and running. Esprit de corps, which is really about leadership and the good feeling that sites have. So this is a typical model that can be used for project managing. The communication element of it, though, is obviously made a lot easier if you've got good IT systems. So you're all sharing one lot of information. So for instance, you could put all your drawings onto OneDrive or Google Drive, SIMPRO, being it's near him. IT these days is actually crucial to communication. The problem we've got is that a lot of our communication these days is quite unstructured. people using WhatsApp and things like that. And what happens is when you're using WhatsApp, you miss what's going on, or if there's an instruction in there, it doesn't get formally recorded as an instruction and go into the contract. So, you know, you need to think about your communication methods. But having said that, if you've got your project processes in place and everything's set up, what can happen is that you start then to lose money because things are not done efficiently. Now, the Association of Project Managers looks at a triangle, and they tend to think of things in terms of quality, time and cost. If we take quality first, you know, things like reworking, snagging, not, oh, this is crazy. Is snagging, all of that sort of thing is going to cost you money. Now, there is software out there, oh Jesus, there is software out there that you can do snagging on. Things like Plan Radar, you put a pin on a drawing, take a photograph, and you can see when whether a snag's been cleared or not. O&M manuals, getting them together so you've got a quality handover is always a time-consuming effort. There's software out there like Docket that you can use to start putting your O&Ms together earlier. Docket happens to link with SIMPRO, so it can be done separately. So think about the software for managing quality. Time, obviously time is money. The quicker you can do a job, the more money you will make. The chances are your prelims will be lower, and therefore you might have a competitive edge against someone. Time management is often done best using bits of software like Primavera, Asta or EcoSoft, Power Project, something like that, where you can do a proper critical path. So time management and planning can be done quite separately on specialist software, and there's people out there that will do that for you. The other thing I've included within time is safety, because that sort of encompasses everything. And a lot of the safety consultants have got their own types of app out there, A-Site, iAudit, Yellow Hat, all sorts of bits of software out there that you can use to help monitoring your safety. So that's time. And then cost, obviously waste is disruption, all of those sorts of things. You can monitor those, but you have to do that through the cost packages. So what you do is you start off with a really good estimating package. Things like Conquest is one, Ensign, I know the electricians like Ensign, but you start off with your estimating packages and get everything down into labour, plant and materials, and then what you can do is you can compare your actual costs with what you estimated using software like Planyard, or quite often even in large businesses they're still doing it with spreadsheets. And spreadsheets are easy because they're adaptable to all the different ways. If we sort of look at one that's set up here, you know, you could have every single activity here. So you could have a ground worker, say here, or a dry liner, whatever main trades. You can then break it right down, and the ground worker could have theirs set up so it's got paving, drainage, you know, everything. So you've got on the left-hand side here your labour, plant, material, what you planned out of your tender. On the right-hand side, what your actual costs are. And this is assuming that you're posting everything to the correct place in your accounts, because the accounts people send back to the surveyors what the costs are on their jobs, and then you do a variance. And that's when you start to really see where you're winning or losing or making money. Now, if you're losing, the chances are it's to do with variations or something that's changed. And this is where contracts and the commercial side and how much risk you're taking on comes into play. So there's suites and loads and loads of different types of contracts. I've just put up some pictures up there of the JCT, because that's a well-known contract and it covers all types of contract. If you haven't got proper terms and conditions, or you don't know what you're signing up to, you know, take some advice, because you can really get caught out on that. So contracts, all sorts of contracts there that you need to look at. Some are better for contractors, some are better for clients, some fall in between. But getting the right contract is very important. Now, within the contract, as you go through, one of the things to do is to also monitor the progress of the job compared to what should be happening. And if you find that there's discrepancies, then there's a disruption protocol that the Law Society have produced. And what you do on that is you say, this was what was planned, this is actually what happened, the difference must be costing us money. If it's somebody else's fault, therefore we need to claim it. And this document talks about how to do that. So, take away from this, get some records in place. It's records. As a famous Irish lawyer once said, and compare what was actually planned with what you've done. So, sorry about the slides rolling. I think that must have been somewhere behind in the clicks. If you need any help with that, obviously I'm around later. Cheers.
Thanks, Peter. It's then about reviewing your reporting, knowing what's happening in your business and where it's going. So the first step is to find a package that's more than just compliance. Rather than just ticking the boxes, doing a VAT return, is have something that's robust enough to have that reporting structure. Once you've got the structure, it's about understanding your margins. Now, there's a difference between gross profit and net profit. Won't go into the details, but effectively it's knowing that difference and knowing where your costs sit. Are they overheads, are they incurred, or are they gross profit? Do they flex upon the work you've got available? As your business grows, margins will change. As you set out as a sole electrician, there's a lot of own labour, which is actually done in your time, and that means that the profit you make, you won't see those on the gross profit margin. So your own labour isn't impacted. As the business grows and you take on 1 to 10 employees, that labour will then hit your gross profit margin. You then need to be conscious of how much of your own labour should be within your gross profit margin. It also means that as you manage the business, managing your business and understanding you've got employees, you've got workers, means that you're having to manage the time, you're having sort of more time spent, and that will impact on your gross profit margin. Over time, your gross profit margin will settle, depending on your management strategy, how you're running your business, and as a result, that's the point at which you then need to work on how you can eke that up. Do you need to have a more rigid structure in place for your employees? Do you need to manage their time more effectively? It's then making sure that your reports cover everything you need, including all of the costs. As Peter mentioned, we need to make sure both time and expenses are covered. Covering one or the other means that your gross profit margin isn't truly reflective of where your business is. The next is making sure you attribute all of the costs of the job. As Peter mentioned, don't just put it to overheads. You need to make sure it's attributable to a job. You need to know which ones are profitable, which ones aren't. You then need to have a reliable system that tracks all of that, the time and the expenses. And margins can swing significantly if you've got unattributed costs. If you've got 50% of your labour is sat in overheads, it just means that actually that should be, if it's chargeable, it should be in gross profit. You're artificially inflating your gross profit as a result. So this is an example of a profit and loss on a job from some software. And the important part to take away is that actually for each of the jobs we've got listed down here is that we're including the appropriate material cost, the resource cost, and we've got our gross profit margin and some attributable overheads with a net profit margin. So the software itself should be capable of doing that for you. It should be easily visible, it should be on site. Again, a very similar report where we've got material costs and direct costs which are attributable, again giving us a net profit, gross profit, loss, but for each of the areas of your business. So not only just on a job basis, it's on each of the areas that your business does, whether it be CCTV or design and scope, knowing where you're making money and not making money